Today we discuss which parts of the equity markets are most over and undervalued, and if the feature of KKR in 60 Minutes is a buy or sell signal.
This is InvestTalk, independent thinking, shared success.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Tuesday, May 7th, 2024 edition. I'm Justin Klein, and I am here to help you navigate through the maze of financial information, headlines that are flying at you every day on traditional media, social media, and beyond. And this show is about helping unpack the issues that should matter to you and get you ready for this new era that we continue to try to navigate through, of higher interest rates, more geopolitical volatility, more political volatility, and ultimately a fiscal situation on the sovereign level that is nothing like we've seen in our lifetimes. And so it's important to have your eyes wide open, understand the risks and rewards of everything that you are looking at in your portfolio and what you may put in your portfolio. And that's what we're here to help you with. And we do that by answering your finance and investment questions. So if you have something in your portfolio you're not sure about, maybe you're thinking about adding something to your portfolio that you're not sure about, give us a call. We can answer your question on today's show or on a future show. You can leave your message on our anytime listener line. 888-99-CHART is the number. Either way, live or after hours, it does not matter. So that's what we are here to do. And we're going to talk about the market performance for today, as well as run down some show topics, but right after we tackle our first caller question now.
Hey guys, I had a quick question for you. I was watching 60 Minutes on Sunday night, and they did a special on KKR Company. I liked everything they were saying in the segment, but I wanted to make sure I wasn't getting sold on the story, like you guys like to say. So if you would, I added it to my watch list, but I just wanted to hear your evaluation before I made a purchase. Appreciate it. Thanks.
Well, let's just say this. When a company or a sector as a whole hits the mainstream media, and there's no bigger mainstream show than probably 60 Minutes. Is everybody on board? Is I think the question you have to ask yourself. Now that doesn't mean it's the only thing you think you only factor you consider. But that would always make me more weary than excited about the name. Now, KKR is one of the world's largest alternative asset management companies. Think of private equity. That's what they're big into. Their core segments are asset management, which includes private equity, private credit, infrastructure, energy, real estate. These are all areas that there's not a lot of transparency to. We've talked about that. Their investment vehicles, you don't really know what's in them. They're not really mark to market, et cetera. And that's what I don't like. Now, their business, at least right now, is pretty good. They have high asset values and they're earning a fee on that, but they're highly levered. You have about 65-ish billion in debt on a market cap of 88 billion. That's kind of a lot. The return on equity is only 7%, return on invested capital 4%. That's not that exciting. So, and it's trading at a pretty high multiple. Forward-looking enterprise value EBITDA is 29. Don't love that. Earnings this year are supposed to be up 37%. And so near-term things are good, but it's to me, it's a leverage play on asset prices. And I don't love that. I don't want a name that is so tied to the higher cost of capital. And so I just don't think this is a great risk versus reward. Now, technically, it's fine in the near term. When I say technically, I'm talking about the chart. It's certainly in an uptrend, and I don't think it's going to fall apart anytime soon. But I will say there are some indicators like MACD that are starting to roll over, and I worry a bit about that. So just because it's on 60 Minutes is not an indicator that to buy it, and frankly, it would be more an indicator to stay away. Thanks for the call. Now, we have a lot of ground to cover over the next 45 minutes, and our main focus point is about the opportunities in the stock market after a tough month. So we're going to talk about broader sectors, different style factors, and what general valuations are for those different subsegments of the overall market. We're also going to touch on a few other topics. One is in regards to the recent senior loan officer survey out of the Fed. And this is always important because so many people talk about dollars in the system and money printing from the Fed. And, if you're focusing on quote unquote money printing from the Fed, which kind of comes in a lot of different forms, and a lot of times it shouldn't really be defined as money printing because it's something else. But a lot of people focus on that, and it's certainly important. But by far, what's more important are what the banks are doing in a fractional reserve banking system. The banks are the ones that create the dollars, far more than the Fed. Yes, the Fed and the Treasury can work together, and they can liquefy the system and get dollars out into the system using various means. But banks do that too by levering up their balance sheet, lending, etc. So we're going to look at that survey because it is so important to the overall economy. In addition, we're going to discuss Gen Z, millennials. What's the younger generation spending on? In 2021, Gen Z and millennials spending hit 2.7 trillion here in the United States, and that was 30% of all spending, and we know that's been going up since then. So it's important to unpack the trends in that cohort of the population because they're the ones that will continue to spend more and more as they advance in their careers. They get older, they enter their mid to late 30s, into their 40s, start to buy homes. And, their buying habits, spending habits will be very, very important. So we're going to look at that. And then lastly, IPOs. What should you look for an opportunity in the IPO space? We always talk about IPOs generally overvalued. Upon first trading day, they typically are not great to invest in. But what patterns after the IPO can indicate that, now it is time to jump in, maybe weeks or months after the initial public offering. We also have voice bank questions. One is on homes and interest rates, and the other is on Revolution Medicines, RVMD. And of course, comments from our comment section, or questions from our comment section on our InvestTalk YouTube channel. But most importantly, it's about you and your live calls. We welcome your finance and investment questions right now on 888-99-CHART. Now we're going into a short break. On the other side, we'll talk about today's market activity. But please remember, once again, you can call anytime and leave your question on the InvestTalk voice bank at 888-99-CHART.
You are invited to be a part of our learning experience. Simply use the InvestTalk voice bank to record your finance and investment questions anytime, 24/7 at 888-99-CHART.
Enjoyed our insights on InvestTalk? Great news. Our podcast is available on all major platforms. Make sure to subscribe wherever you listen to your podcasts. Get the latest in investment advice across Spotify, Apple Podcasts, and more. Subscribe now and join our community of informed investors. Now let's take a look at the market today, and it was another up day, not a big up day. The S&P was up about 7 points, so a little over 0.1%. And the broad large cap market, that's what it was up, 0.1% on the day. Small caps up 0.13, so they outperformed. The best sector today was actually mid cap value, up 45 basis points. The worst sector, mid cap growth, down 33 basis points. That was on the back of Palantir after earnings down 15%, finally getting a bit of correction from its pretty high valuation. Solid company, but those results didn't meet the expectations. You also had big down day from things like Lucid Group, down 14%, Teradata down 14% as well. So kind of a mixed bag, definitely into resistance in the short term. We've had this nice rebound from the lows of May 19th, and we are in the high end of what we call the Bollinger Band on the charts, and that typically brings some, at least near-term resistance. And we're also kind of at the area where we consolidated before the breakdown in mid-May. So it would not shock me to see a bit of a market step back after this most recent move. Not a lot of catalysts for that, to be frank. Earnings after hours, I think there were a couple stinkers out there. And, overall today it was flat up, but not very much. And like I said, into some major resistance. Now, you probably noticed that we are excited about our new YouTube channel. It's about we've been going live here with these videos and data that we're sharing our screens and everything that comes with our YouTube videos. But each night we get comments in the comment section, or questions in the comment section. And here's one that came in a couple of days ago. Copy 321 says, what are your thoughts on HIMS preferred entry price? And this is a name that has spent a lot of money on advertising out of San Francisco. They're in the wellness space, shall we say. They provide healthcare software solutions and health and wellness products in the United States. They sell a lot of erectile dysfunction drugs via mail. HIMS stands for Hims and Hers Health Inc. And their revenue growth is very strong. Last quarter, revenue growth was 46%. Now that is down from nearly 100% revenue growth in late 2022, but still healthy. Earnings growth was up 200%. So to make $12 cents per share this year, 21 cents per share next year. So that growth is pretty solid, but even if you're going based on forward-looking earnings of 21 cents, you're talking about a 60 times multiple. That's a bit rich for my blood. And if you look at things like price to sales, you're at about 3 times. It's a little high, but for a tech name with this growth, it's not terrible. What I don't like are the operating margins, negative 3.3%. And I worry that this is one of those names that is focused more on the top line than the bottom line. And historically, that's been the case. And in order to plug that cash flow gap, they've been increasing the number of shares outstanding consistently, really since 2021, when they had about 200 million shares outstanding in July. And now we're at 214 million shares outstanding. Not a dramatic increase, but a consistent increase. And I don't like that. The technicals are pretty solid, as pulled back to the 100-day moving average, and that's good. But, I just don't like these money losers. Free cash flow is positive. That's good, but not enough to get me excited about Hims and Hers. So, frankly, I'm just going to pass on it. I don't love that lack of profitability. Thanks for the call. Now let's keep things moving and pivot back to the InvestTalk voice bank for a question that came in earlier.
Hey, this is Andrew from Atlanta, and I was trying to get in touch with Justin or Luke, and I was reaching out to you guys about ticker symbol RYI. That's Ryerson Holding Corporation. I've held this for a while, and I've noticed that it's been dropping a little bit. I'm curious, how does this company, or this holding corporation, how does this look going forward? And if I wanted to pick up more of it, if you think that's an ideal thing, what do I need to be looking for? Where would you want to pick up some more? I think right now it's trading at $22.50. We appreciate your advice. We love the show, and I'll listen for your answer. Thank you.
All right, looking at Ryerson Holdings, and it is a small cap name, only $765 million market cap. They process, distribute industrial metals in the United States, Canada, Mexico, and China. And my issue with this name is that its earnings are all over the place. They lost money during COVID. That was expected. But even before then, their earnings were down. They made $10.54 in 2022, so COVID definitely benefited them. But this year, earnings are expected to be all the way down to only 99 cents per share, then back up the year after. So, I don't love that. Return on equity right now is 20%, but it's longer term. It's just too volatile. It was didn't have return on equity before 2018. So the technicals are very poor. I don't like the consistency of earnings, and they have a decent amount of debt in their balance sheet. So I would just sell it. I would move on. Not a name that I would want in my portfolio. Now we're moving into a short break, but my phone lines are open waiting for your calls at 888-99-CHART. Hey, InvestTalk community. Justin and Luke here. We are so thankful you've been with us through this investing journey, but we are just getting started.
That's right, Justin. We're excited to bring you more exclusive content. Think more of the critical analysis and expert advice that you love.
You'll get insights into smart investing strategies to help you navigate these turbulent times.
Don't miss our live Q&A sessions every weekday at 4 p.m. Pacific, where we answer your burning investment questions.
Just call our InvestTalk listener line at 888-99-CHART, leave your question, and we'll tackle them on the next show. Who knows? Your question could be the next big topic we explore together.
So stay tuned and call 888-99-CHART to leave your comments. We're here to make investing accessible, understandable, and hopefully even a little more fun.
Chart your path to financial freedom here with the InvestTalk podcast. Now, our main focus point is about the opportunities in the stock market after a rough month of April. Now, we've bounced in the first week of May, but April saw a broad-based retreat in markets. The broad Morningstar U.S. Market Index was down 4.3%. And now I hear this a lot, that the market is overvalued. I don't want to get in. It's too expensive. The market's overvalued. But if you actually run the numbers, the market is neither expensive nor undervalued. It's about fairly valued, especially after this recent bounce. But there is a wide difference between different segments of the overall market. Now, the growth category fell the most in April, down nearly 6%. Value was down about 4.4%. And large caps fell 3.9%, whereas small caps fell 6.5%. And what's pretty clear here is that when there is volatility, the growth side of the market definitely underperforms because that's where most of the overvaluation is in markets. In fact, the value category in general trades at about a 9% discount to fair value. And small caps have the deepest discount of all the market cap sectors, subsectors of the market. On average, most small caps trade at about a 20% discount to their true value. Large caps are the ones that are pretty much near their fair value. So if you're talking about opportunity sets in the marketplace, it's mainly in companies that you probably don't know much about or haven't heard of. Mid caps tend to trade at about a 7% discount. Now, on a sector basis, there were some outperformers and some underperformers. The worst sectors in April were tech, healthcare, and real estate. And there's one main reason for all three being in the worst category were higher interest rates. We know that real estate tends to be interest rate sensitive, and you certainly got a pullback in that, especially those names that are exposed to office real estate. But there were some babies thrown out with the bathwater. Think of more resilient defensive sectors of the real estate space. Think healthcare, triple net lease providers, etc. That's where the undervaluation tends to concentrate. In tech, obviously, there's many large cap names that are overvalued, but some smaller mid cap names certainly became more attractive. In the healthcare space, that is also subject to higher interest rates. A lot of those companies are highly levered and they pay good dividends, and therefore they are bond proxies, just like real estate tends to be. Okay, so technology, those tend to suffer during higher interest rates because of the farther away nature of their cash flows, right? A lot of them, it's all about the growth, and they're not making money or much money right now, but 5, 10, 15 years from now, they're expected to earn a lot more. And so that's why they kind of had that setback. So those are the sectors that underperformed in April. And I think most of those still remain relatively unattractive, although there's some subsectors, like I said, of real estate that do look attractive. Now, what did well in April? Utilities. They actually they were up 1.7%. Energy also did well. That was down less than 1%. And consumer defensive was down 1.3%. Now, utilities, they were all very attractive back in October when interest rates are very high. Now they're about fairly valued. So not a whole lot of opportunity there, but I think there's still some parts of the utility market that remain relatively attractive, especially those utilities that are concentrated in areas where there's a lot of rising demand for electricity. Think of the Smile sector or Smile states of the United States, where there are a lot of data centers for AI being built, et cetera. I think there's some opportunity there. In the energy space, that broadly trades at a decent discount, although because of the outperformance recently, it's not as big of a discount as you saw back in the fall, but still a lot of opportunity within that space. Consumer defensive, it's kind of a mixed bag. Things are improving a bit better in that sector as a whole, mainly because of ebbing inflation. We've talked before how consumer defensive generally in an inflationary environment, it doesn't do very well because those costs of doing business are difficult to pass on to the consumer. Higher transportation costs for getting products to market, to the stores, as well as paying employees, et cetera. All those inflationary pressures tend to weigh on profit margins in the consumer defensive sector. Think of packaged food companies, grocery stores, et cetera. Still some opportunity there, but generally not a place you want to be overweight overall. And then what is the sector at the biggest discount? That would be basic materials. Think of gold miners, crop chemical producers, fertilizer companies. Those tend to are the most undervalued in the market right now. So that's a broad overview of where we're at as we embark through this month of May, where there tends to be some market volatility. Sell in May and go away. I think that saying's a little overblown. Depends on the year, depends on the earnings trends. And generally, we've talked about earnings trends so far for the first quarter were pretty good. Beating expectations about 80%, so higher than average. And so those that say, I don't want to put money in the markets because it's too expensive, you're really not paying attention to the facts on the ground. The facts are that things aren't cheap or expensive, but it's certainly more of a stock picker's market. And if you do the work, you can find some great values in this market. Now we're heading into a break, and I'm ready to take your calls at 888-99-CHART.
Did you love today's InvestTalk episode? Well, we want to hear from you. So drop your investing questions in the comments below, and your question could be the star of our next segment. Subscribe and stay tuned to see if your question gets answered by us. Dive into the comments now and become a part of our next conversation. Do you want to take your investment strategy to the next level?
We invite you to visit InvestTalk.com and submit your portfolio for a free review from us.
This is a fantastic opportunity to receive personalized advice and insights to enhance your results.
Don't let this chance slip by. Go to InvestTalk.com, submit your portfolio, and let us help you on your journey towards greater investment success. Thank you for watching. Make sure you like, subscribe, and hit the notification bell so you never miss an episode of the InvestTalk podcast. On the next InvestTalk, we'll look into this question. Is AI a bit overhyped in the short term? One billionaire investor has slashed his big bet on the chip maker that was one of the best performers last year when it was up 238%. We'll dig into that story tomorrow, but for now, let's play another listener question that came in from Atlanta.
Hey guys, this is Chris from Atlanta. This question's primarily kind of directed towards Justin. I know over the years you've discussed how a home is a utility, and they're not investments. I did have a question. Currently going through a divorce and looking at rentals and buying right now with the higher interest rates. I'm having a tough time making a decision on renting and waiting for an interest rate to drop and buying at a better time. I can find mortgages for approximately the same rate as my rentals. Just trying to figure out what's the best way to manage this situation right now. I'd want to look at it from a independent point of view, see what your take was on how you would address a situation like this right now with the given mortgage rates. Look forward to hearing the answers. Thank you.
Well, to your point where you started, which was that your personal residence shouldn't be thought of, at least primarily, as an investment. Secondarily, maybe, there's some factors to consider there. But mostly it's the utility of the home, comfort, reliability of, that home, the amenities, location, and just how happy living in that home makes you. And that's what's most important, because, you could live in a home for a decade, but if you hated it the entire time, you just gave up an entire decade of your happiness just to, maybe make a few dollars. Not worth it, right? So you want to think of your home as its primary purpose, which is utility. Now, when you're thinking about buying versus renting, if you're going to buy and you think there's kind of rental parity, that's kind of what it sounded like, that the cost to buy and get a mortgage and pay that mortgage and all the other costs that go with owning that home. Think of homeowners insurance, property taxes, maintenance, etc. You have to look at that all in, not just the mortgage, and then compare it to a rental. And if that's on par, then it comes down to, okay, do you want to be in this area for an extended period of time? If you go rent somewhere after a year, you don't like that area, you're not happy there, you can go move very easily. You own a home, you have to go sell it and market it, and it can be more of a challenge to sell it. And you may be up or down depending on kind of the market environment since when you bought that home. So what I say is, if you're going to buy the home, you have to be very sure that you like that neighborhood, that you like that area, that you like the amenities, that you're going to be happy in this home. That's to check all the boxes. Otherwise, it's better to be a bit more patient and wait for the one that does, right? Why commit to something you're half in on when you can rent for another year and maybe find the one that you're fully in on and you love living here? This is exactly what you need. And either way, your cost of living sounds like the same. And then there's the upside of, if interest rates do pull back, you could refinance and lower that overall cost. So that's the way you want to think about it. Don't tie yourself to a piece of real estate that you aren't really head over heels for in this market environment. Now, generally, I think because of inflation, housing prices are in most markets going to go up. Now, there are certain pockets, think of Austin, Texas, the Bay Area, in California. There's some broader trends that are going to weigh on prices, I think, for an extended period of time. So those markets, you want to be even more cautious. But in general, you just want all your boxes to be checked. And there's no reason to compromise when you're committing, basically hundreds of thousands of dollars and maybe more of your capital in order to live in a certain home. Thanks for the call. Now, let's pivot over to the latest bank survey. It's a Fed survey, and it's the Senior Loan Officers Survey. And I talked at the top of the show how this is a very important, undercovered report. It's kind of crazy to me that mainstream, CNBCs of the world haven't really caught on that this is one of the most important reports that come out every quarter, because it has such a large impact on credit availability and just the general credit channels. And that's really what monetary policy is made to do. It's you raise or lower interest rates in order to make those credit channels tighter or looser. And the Senior Loan Officer Survey is answering the question, does that work, or is that working? And the simple answer in the first quarter was, yeah, it's working pretty good. And that ultimately, frankly, is going to be a drag on the economy. Now, was it major? No, it was a minor weakness in demand for many things like industrial loans and consumer loans. And there was a slight decline in household demand for credit as well. Now, there was growth in places like commercial real estate, where some banks loosened their credit standards. And that's what this is all about. It's about, are banks tightening or loosening their credit standards for various types of loans? And then what is the demand for those loans? Okay. So in the commercial real estate market, both there was higher demand. We talked about refinancing commercial real estate, for example. And after a couple of years of just consistently tightening lending standards in that space, banks are starting to loosen those standards. Okay. So that's a positive for that part of the market. Now, the net share of large and medium-sized banks reporting tightening standards for commercial and industrial loans. This is basically the vast majority of business loans that are out there. And that ticked up from 14.5 to 15.6, meaning slightly more banks are tightening their lending standards. And they also showed a weaker demand for C&I loans. So what they're saying is banks are being are scrutinizing applications for these type of loans a little bit more, and that the demand due to higher rates for businesses to go out there and borrow to expand their businesses, expand what they're doing, dropped a little bit because of those higher rates. So that was something of note. On the household level, a rising share of banks reporting tightening standards for things like auto loans, but they expanded or they shrank the number of standards for things like credit cards and consumer loans. So they're lending more in the credit card and consumer loan space, but less in the auto loan space because clearly the price of used cars going down. And that ultimately means that the collateral is not as strong, and they probably have a lot of auto loans on their balance sheet, and they don't want to get more exposure to that because that was an area of loan growth for many years post the pandemic. Now, the demand deteriorated across almost all categories, the survey said. So it just shows you the average household, they're kind of scared off from these higher rates. So once again, those higher rates are having an impact on end demand. The weakest, auto loans, weakest in a year. So it just shows you this is why the Teslas of the world and many of the auto companies, they're not doing so hot right now because the consumer, they don't feel a need after really reaching to buy a lot of cars over the last couple of years, trying to get their hands on, one they liked. They're kind of pulling back. And so that was the last main takeaway from this report. And it's always important to follow this and look at it. It's a quarterly report. So it is a bit backwards looking. We're looking at the first quarter, but ultimately that does tend to trickle into the requisite quarters and allow you to get a real sense of what's happening in the broader lending market. Now let's pivot to a YouTube channel question, we will pivot to a YouTube channel question. But first, let's tackle another caller question from 888-99-CHART.
Hello, InvestTalk. I would like to know your opinion about Revolution Medicines, ticker symbol R as in Romeo, V as in Victor, M as in medicine, and D as in Delta. This company is not really making money, but is growing like crazy on expectations of new drug for cancer. I wanted to get in there, but then I look at the balance sheets and I see only losses. Let me know what you think, if this price above 40 makes sense, or do you see something else? Thank you. By the way, leaving a voice message and hearing the answer is it's a great idea of yours. It's a very nice feature. Thank you.
Well, thank you for that. We've been doing that for nearly 2 decades now. Crazy. But thank you for the call. Looking at Revolution Medicines, it's a clinical stage precision oncology company focused on developing novel targeted therapies to inhibit elusive frontier targets within notorious growth and survival pathways. And basically what that means is it's your typical biotech name that is promising that they have the cure for many types of cancers. And historically, have we cured cancer? We have not. And so, is this the one that does it? Hopefully. I pray that it does, right? When nobody likes cancer. We all want cancer to be eradicated. It's a terrible thing. But Are you going to bet on that? Is this the name? I don't know enough about, these particular drugs, but as you said, with their balance sheet, this is a company that really doesn't have any revenue. Earnings for this year and next year continue to be deeply negative. And all they're going to do is continue to issue more shares and dilute you, the shareholder. And then there'll be some sort of announcement about the clinical trial, and it fails and the stock drops 50%. That's what happens typically. And then it meanders for a while. You get another clinical trial and maybe things look a bit better and it might rally 30%. But in general, long term, it tends to just eat shareholder capital. And this went public in 2020. Now, it is up from its IPO price. That's interesting. So that's good. But you have to have a lot of faith in their particular drug or drugs. Frankly, I don't know that. I haven't done the deeper research. But based on the history of biotechs and the massive cash flow hemorrhaging that this company does on a yearly basis, negative $358 million trailing 12 months free cash flow on a $6 billion market cap. Now they have a good amount of cash from all the shares they've issued throughout the years, so that's good. So they have some runway here, but you really have a lot of faith in these new drugs, but not something I would jump on. Here's another question from our InvestTalk YouTube channel. User EM8 says, what do you think of PLAB, stock for long term? Looks like an interesting play. PLAB is the symbol. This is a name that's in a pretty nice uptrend. It's been consolidating after I'm assuming a good earnings report back in December, and it's been consolidating between $25 and call it $32 per share ever since. And for everyone else out there, they manufacture photomasks used in the fabrication of semiconductors, microelectronics, and flat panel displays. Photronics is the name. What I like is that earnings generally consistently rise. I love that. Although revenue growth is slowing, it was only 2% last quarter. A year ago, that was in the high teens. Earnings growth last quarter up 20%. No dividend here, about a $1.8 billion market cap. But once again, I like that trend of consolidation. Let's go look at its balance sheet real quick to see what type of debt it might have. Net cash on its balance sheet, so I like that. Free cash flow, $172 million. I like that. Return on equity, 11%. Not amazing. Let's see the history of return on equity. Kind of mid-single digits. Not that exciting. But I like the fact that they have pretty good free cash flow yield, about 10% free cash flow yield. That's good. They've been buying back shares basically since 2018, so that's a positive that they're taking that excess cash and generally buying back shares over the last 5 years or so. So that's good. Enterprise value EBITDA around 4.5, so it's relatively cheap. I'm going to give this one a little bit of thumbs up. Mainly, I like the consistent growth of that earnings and its cash flow. Free cash flow, like I said, $172 million. And that has been trending higher basically since 2020. So I'm going to give PLAB a thumbs up. It's neutral to slightly bullish on the chart. And I like the fundamentals overall. Thanks for the call. Now, after the break, I'm going to touch on IPOs. What to look for when a company goes public. Should you jump in the first day, or is there a pattern to the price that will give you a inclination that, hey, things are headed in the right direction? Or could it be one of those clunkers where they drop 70, 80, 90% from their IPO price? So we're going to dig into that on the other side of our final break. So if you have a question, I encourage you to give us a call live at 888-99-CHART. Enjoyed our insights on InvestTalk? Great news. Our podcast is available on all major platforms. Make sure to subscribe wherever you listen to your podcasts. Get the latest in investment advice across Spotify, Apple Podcasts, and more. Subscribe now and join our community of informed investors.
Is something on your mind? You can call us 24/7 at 888-99-CHART with all of your finance and investment questions.
Hi, this is Brett from New Jersey. I just want to thank you guys for all that you do. Also sending my best wishes to Steve. Hope he's back soon. I was hoping you could take a look at Enerplus Corporation, ERF. I know they're being acquired by Chord Energy. I looked at Chord Energy. Chart looks good on the constant trend upward. Could you take a look at the deal and also Chord Energy for me? Thank you very much. Bye-bye.
All right, looking at Chord Energy and Enerplus. Enerplus is the name that we own for clients, and then they got bought out, and it's a stock and cash deal at roughly $11 billion. It's supposed to close sometime in Q2. We're a month and a week into Q2. So it looks like, let's see, I'm trying to remember the terms of the under the deal. Each common share of Enerplus will be exchanged for 0.1 shares of Chord common stock and $1.84 per share in cash. So it's basically 90% stock, 10% cash. And that's why if you own Enerplus, or you see the chart of Enerplus, it's been highly correlated with Chord Energy. Now, generally like the consolidation. So Chord Energy is supposed to earn $20 per share this year and $21 next year. It's even after this acquisition on a $178 stock. Talking about a 9 times forward-looking earnings. Pretty solid 2.8% dividend yield. And generally I like it. We like the Enerplus. Obviously, Chord is really not that much larger. $4 billion market cap for Enerplus, 7.8 for Chord. So certainly this will expand the number of shares outstanding, but it will bring in Enerplus as well. So combined, it'll be over $10 billion market cap. I like it. There are better names in the space probably, but it's a solid name that I think is making the right moves. So I have no problem buying Chord, but you could also own Enerplus, get some cash as well as Chord shares. Thanks for the call. Now, lastly, let's talk about the IPO market. And everyone gets enamored with IPOs, but there are some price movements that can tip you off to whether things are going well. Now, the first way to avoid major losses in IPO is to chase the initial run. And if you look at history of IPOs, it's littered with broken companies that are up big initially. There's a lot of hype around them, and then the lockup period happens 6 months later, and the stock gets steadily sold. And 2-3 years post, it's down 70, 80, 90% because it went public at way too high of a valuation. The owners of the company many times will kind of juice the business and kind of pull some levers to make everything look better than it really is in the near term to create an exciting environment around those shares so that they can sell it at a high price. And that makes sense. But there are other names that, they might do okay the first couple of days, and then maybe the stock meanders for a while. Few weeks, few months, but it doesn't go down a lot. And then it slowly starts to rise back to its all-time high. And those are actually the ones that you want to be buying. The ones that have modest dips, 20, 30%. Let's call it 10 to 20% from that initial high, and consolidates that and really brings in consistent buyers, proves their worth, and is at least meeting and maybe beating expectations a little bit. So, for example, stock went public at 20, first few days it went up to 30, and then it declined back into the low 20 range and sits there for a while. Well, when it starts to break out again above 30, that's saying that it's proven itself. It's worked through a lot of the maybe overvaluation. It's worked through the the hype, and it's creating some level of consistency to the business. And investors are truly buying in, not just on the initial offering, but after as well. And so when you're looking at IPOs, you probably should watch them for a little while to see if they can find some level of stability, and then you can buy in. But buying right away is typically a fool's errand. Thanks for the call. Or thanks for the show. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate on iTunes as well. And of course, you can catch our podcast in video form over on our YouTube channel. Just go over there and search InvestTalk with 2 T's. Independent thinking, shared success. This is InvestTalk. Good night. Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.